Hey, good morning, everybody. It's Hammer. What is today? Today is Tuesday, February 27th, 2024. I, of course, am with Originator Success here with your daily rate conversation, your daily mortgage rate update, the only place on the web where you guys get to be a part of the conversation. Appreciate you joining me. Remember, you can join me live each and every day, 9:30 a.m. Eastern time as I do this show for you. Remember, if you're watching the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. If you're on Facebook, don't forget to smash that like button, tag a little friend, share us in a group. If you're on YouTube, give us a thumbs up and go ahead and subscribe. Remember, you can go ahead and sign up for our written emails that go out to your inbox each and every weekday morning, www.ratelockadvice.com. You can go ahead and get our text alerts. They're $7 a month. Can't beat them. You should join them. www.ratetextalerts.com. Last but not least, check us out at originatorssuccess.com. Find out how we help you get loans from Google and social media. And if you'd like a reminder, text alert when I'm going live every morning, go ahead and use this QR code or one of those handy dandy links, and we'll send you a text when we're going live. So all that said, let's say hi to our live folks here this morning. Of course, my man Ron Siegel here. Good morning, Ron. Great to see you, sir. Who else we got here this morning? We've got Kelly Cargill. Good morning, Kelly. Kyle Mazikas, Rob Stewart. How are y'all today? Hope you're doing well. Someone on Facebook, but I don't know who you are, but I love you anyway. Lisa Bollinger, good morning. Great to see you. And a bunch of other people I'm sure will start trickling in any minute. Let's go ahead. Oh, there he is. We got some Tom Stafford. Good morning, sir. All right, let's go ahead and dive in. So this morning, rate sheet's going to be a little bit worse than yesterday. Not really a ton. I mean, certainly not any worse than what we saw last week. Things have been holding kind of steady sideways, but that's about as good as it's going to get. The outlook definitely remains the same, that the idea of the Fed chopping rates anytime soon has been pushed off. Markets are coming to terms with reality, and that means rates are not going to improve. Now, reprice risk today is moderate. Bonds this morning already looking kind of defeated. Mortgage-backed securities down about 5 basis points to start the day. 10-year Treasury yield at 4.30. You can see here on the 10-year. Let's see if we zoom in a little bit, if it'll let us scroll, or if I nope. I got every time I zoom in, I got to refresh the page. It's always a pain in the neck. But anyway, while it's refreshing, the 10-year Treasury is at 4.3, and it's testing up against that. I don't want that. Let's go ahead. There we go. All right. Seriously. I just refreshed it. Why will you not scroll over? There we go. Okay. So looking here, you can see we're testing this 100-day moving average. I don't expect that this is really going to hold up all that well. We have seen it holding up all the way back to the 13th. So it's been 2 weeks now that this 100-day moving average has been holding that 10-year Treasury yield under wraps, stopping it from exploding. The 1 day here, it started above in overnight trading, like the next day it started and then dropped and ended there. So we have this has been a rock solid level of support, but you could see, we continue to test it. And what's going to happen is if that PCE data comes in, next week or on Thursday, if that PCE data comes in as bad as is expected, showing the worst inflation since January, like the CPI did, where it was a disappointment, you're going to see this break above. And keep that in mind. It's just not looking good for where we're at. The outlook is very much the case that rates have settled back to where they should be. And I use should, let's say in quotes, right? Rates are settled back to where they should be based on the current labor and economic outlook. Now, Ron has pointed out many times that there's a lot more weakness in the markets than we are led to believe, but yet the reports still keep coming out strong. Markets are now more in line with what the Fed has projected for rate cuts going all the way back to last year. The Fed said that they were going to cut 3 times this year. That was what they have on their dot plot, 3 rate cuts. And very much an interesting article in Bloomberg this morning that really kind of sums that up as well. Fed rate cuts are likely to be slow, but not necessarily steady. And that's the other reality, is that even if we get a cut, it doesn't mean that they're going to cut and cut and cut and cut. Most likely, we're going to get our first cut maybe June, possibly July, depending on how the data starts to come out over the next few weeks and maybe even months. We got March and April data. So we may see our first cut in June, if not probably July, and then they may take the next one off, especially if there are 3 cuts. Now, if they look to cut 3 times, they may do a June, a September, and a December. We've seen that kind of activity before. So it really depends on how the data comes in. Good morning, Robert Bashirs. Good morning again, Ron Siegel, Sheila Garcia, Joanna. Great to see you guys all as well. So taking a look, I mean, it really is a huge difference. The idea of a rate cut here in March, gone, totally off the table. Remember, it was a 75% probability that we were going to see that cut. And markets were pricing in stuff. They were writing checks that their body couldn't cash. They really were looking for forcing the Fed to see rate cuts early. That's why we rallied and saw the best rates that we saw in December. Now, as much as this sucks on a bunch of reasons that rates aren't going down, it's going to help with EPOs. I mean, like, that's kind of the only real positive I could look at. The reality is that if rates were to drop significantly, people are going to come off the fence. Now, the longer they do hold off like this, a slow and steady rate cut would actually be good, because it's going to see all rates go down in more slow, steady increments. We're not going to see mortgage rates that are going to drop tremendously. So what that would do is it's going to help us to ease through that time frame when rates do go down and avoid some of those possibilities of EPOs and things like that. In 1995, soft landing, the Fed cut, then held 3 meetings. I doubt that that's going to happen this time around, but of course, it is always possible. Policymakers pledge patience and slow pace of rate cuts. And that's been the message from the Fed over and over and over and over and over again. So anyway, lock advice remains. Anything that's closing the next 30 days, I would continue to lock. We've got March 8th coming up in a couple of weeks. That could help us, as well as the actual the CPI data on the 12th, the Fed meeting on the 20th, but then again, it may not. So you've got to kind of figure it out. But the reality is we're seeing rates that are creeping higher. Really, when we look at these technicals, again, this 10-year treasury yield really testing this level. And if it breaks above it, it's going to push back on there, and then we're going to see it move higher. Same thing for the mortgage-backed securities. We have seen overall a very sideways pattern here. You could see that, they dropped down and they were up and down and up and down and up and down. If we were to switch this to a line chart for a minute, you can't do that there. Hold on a minute. It's right here. Nope, that wasn't what I wanted. This is what I wanted. If we switch this to a line chart for a minute, you see the same thing. It's very much a sideways pattern right around this blue line, right? When the blue line is the 200-day moving average. I don't know why it changes color when it does that, but we've gone below it, a little bit above it, below it, a little bit above it, but it really is holding near this 200-day moving average. When we do the line chart, you can see that pretty clear. Let's go back to the candlestick chart, get rid of that. And then it goes purple, right? So anyway, that is what we're looking at. And the reality is if it falls below and stays below that 200-day moving average, then, we're going to see it continue to worsen. Now, it fell below it, worked back up, tested it, was above it, fell below it, caught back up, tested it. We continue to test this 200-day moving average just as strongly as the 10-year is testing this 100-day moving average. So the problem is it depends on the data. So if we get PC data pushes us below. So now I don't think we're going to see rates continue to go skyrocketing. I think we're going to see rates pretty much in the low 7s before you got your loan level price adjustments. If we're using Mortgage News Daily as a reference point right now, we're at 7 1/8. That's right around where we've been, and it's right where we're going to stay. It's not really likely to change anytime. We're going to see the rates, the 8s. I don't think we're going back there, but it doesn't look like we're really going to spend much time improving until we get an idea that they expect the Fed to cut rates. We're not going to see much improvement. Markets currently now, they've dismissed the March cut altogether. There's basically no shot at all. May is almost all the way off the table. It's up to an 80% expectation that it'll stay the same. Less than 20% expectation we would see a rate cut in May. June, that's been about 60%. Expecting that we would see a rate cut, 40% expecting to stay the same. This is where you're going to see it move up and down. So I spent a lot of time looking at the Fed futures because it really does make it easy to see exactly where we've been and which direction things are going from here. Otherwise, this morning, I did like the morning bid from Reuters. They kind of hit the nail on the head on a few different things. Look at the day ahead for stocks and global markets with stocks holding the bulk of recent stellar gains. More anxious bonds are back in focus. Treasuries caught a decent break Tuesday during a heavy week for new debt sales and inflation updates. So debt markets unsettled on Monday as a record 127 billion of coupon debt was sold yesterday. Two auctions. We had a 2-year and a 5-year, and the buildup to them was pretty poor, but then they kind of caught up a little bit and they weren't too bad. Another 42 billion of 7-year notes under the hammer on Tuesday. Right. So that's what we're going to see, 7-year ones today and more. And the 7-year, generally it's quiet, but there was one time it was really had a big effect on mortgage rates, really hurt us one day. Blah, blah, blah. While a heavy supply of new debt has become a feature of the market, tension has been added by the Federal Reserve's stubborn refusal to cut interest rates as it continues to scour the inflation outlook for signs of heat. Kansas City Fed boss Jeffrey Schmidt towed that line again on Monday and used a debut speech on policy to restate the focus on the threat of high inflation and patience in cutting rates. It's what all the different Fed officials have been saying over and over and over and over. We're not seeing any change in that. Another article that I thought was pretty interesting from Bloomberg was is that where did the other one go? I have the same one up twice. All right, hold on. Let me go back to Bloomberg here. There was an interesting article about there's commercial real estate and how painful that is. Let me go to the markets. There was one about the Fed repo. Shit. I think I lost it, guys. I wanted to see one. It was talking about the Fed repo market back in the one that was created when rates started to move higher and the Fed was putting banks in a position where they were running short on capital. And that it just kind of talked about that was still available and that banks were looking more at using it. That was an interesting article to be aware of. So anyway, that's where we're at, y'all. I'm sorry I don't have anything more exciting for you. I just don't think we're going to see a lot of improvement here. That's why if you're going to cautiously float anything, it's closing over 30 days, but we don't necessarily, it shouldn't see rates that get significantly worse from here. And if they do creep up, they should creep back down. But we're not likely to see rates fall back down into those mid sixes again for quite a while. We need to see more signs the Fed's going to cut. So that's it. Tomorrow, I may or may not be live. I don't know. So if you want to know for sure, go ahead and sign up for the text reminders. But tomorrow I'll be speaking in Dallas at a private event. Yes, you can hire me for birthday parties and talking to your real estate agents like other loan officers do. So tomorrow I'll be speaking at a private event in Dallas, flying out this afternoon, and I'll fly back tomorrow night. So, but I should be able to do, especially it's 8:30 in the morning there because it'll be Central Time. So yeah, I should be live. I shouldn't have any problem. All right, y'all. I'll see you guys tomorrow. Make it a fantastic one, and I'll see you then. Bye-bye.